Hey everybody, I'm Robert Yerby, and I'm an insurance professional, and admittedly, kind of an insurance nerd. My friends and family tell me that nobody is going to want to listen to a podcast about insurance. So instead, on this show, I'm hoping to share a story or have a conversation with a guest about some relatable experience, and then show you how insurance impacts that story or topic. My hope is you'll enjoy a few laughs with me and maybe learn at least one interesting thing about insurance along the way. Here we go. Hey, everybody, this is Robert, and it's podcast time again. So thanks for joining, thanks for listening, and maybe watching. We're going to throw this one up on YouTube because this week I have a guest, Eddie Velez. Hello, Eddie.
How you doing there, Robert?
Great, great. We're talking on a Sunday afternoon, so thank you for taking time out of your weekend. I really appreciate it.
No, my pleasure.
And it wasn't that long ago I had you on the podcast, and we were talking about Medicare topics, which is your specialty. But I wanted to have you on again because I had read an article in the Wall Street Journal that alerted me, a guy who really doesn't pay a lot of attention to Medicare topics, but I guess it's going to be a new year, and there's going to be some for Medicare recipients to be thinking about. And you're my guy when it comes to that stuff. I thought maybe you could just kind of fill in my listeners on what's new, what they should be thinking about.
All righty. Well, that's a very loaded question because there's quite a bit that's new. Now, I'm sure that some
Okay.
of it they've already heard on the news, radio, TV, that Part B premium is going up to $206.50. So, ouch, that's a huge increase. And when you consider that it's a 2.8 COLA increase, so on average, it's going up by $21.50, which I think it's 11% increase, which is really, really high. If you are receiving, to give you an idea, about $2,000 a month in Social Security, that means you're going to get $56 increase, and then of course you're going to lose roughly 22 bucks of that for the increase in Part B.
Okay,
And
and
there have
Part
been
B,
other.
but the
Uh-huh.
Part B, that's doctor visits and stuff like
Right.
that. Okay.
So if you remember, Medicare is in two parts. Part A is your hospital insurance, and Part B is your medical. So that covers anything that has to do with a service provider, but it also includes durable medical equipment and Part B drugs, which are any drug you cannot buy at a pharmacy, a medical professional must give you.
Okay.
So Part B increase is a big one. And if I know there are a lot of places where many plans give you what's known as either a Part B credit or a give back. And right now, it looks like the highest that you can get back is about $185 a month. So what that means is that, let's say I'm Humana, and for marketing purposes, I'm going to say, you know what, I'm going to give you $185 a month. So I'm going to pay to Social Security on your behalf $185, which means they're only going to remove $21.50 from your check, for your Part B. So
Hmm.
if you've never had an increase or a give back, rather said, they're going to see all of a sudden a $185 a month increase on top of whatever's left of their COLA increase. So it's a nice chunk of change. It's
Okay.
about give or take $2,000 a year that they get back and keep in their bank accounts. Now, in 2026, they've made a lot of changes. Again, remember last time we spoke about the Inflation Reduction Act of 2022 and what it did to Medicare. What it did really was affect a lot of the Part D, that's the prescription side of the house. And it forced companies to have to find 1,200% more money for the prescription drugs, which there isn't that kind of money in the Part D plan. So they had to take it from the Part A and Part B portion of a Medicare Advantage plan. And now we're seeing deductibles where there used to be none, co-pays are higher, maximum out-of-pocket limits are higher. Dental took it on the chin, no pun intended, because it was easier to cut dental and vision and over-the-counter allowances to free up money to cover these drugs than it was to try to, pull it out of whole cloth. Yeah. So what they've noticed also in 2026 was that the old model of value-based healthcare wasn't working. So they were trying all of these things about treat the person, completely and do preventive stuff and help them where they are with, other types of programs. Like, for example, many a plan have case managers depending on your needs. And then when you would take what's known as a health risk assessment, they would look at that assessment, and if they saw something they can help you with, they would reach out and do so. So one example, last year with a Humana client, this lady could not get to her appointments to get the treatments that she required because the car broke down. Mm-hmm. But because of the plan that she was on, they gave the case manager $1,000 to play with if there was a need that was necessary to help with, because it was hurting the health of the individual. They can do so. So they wound up fixing her car for her. Okay, that's great. They paid up to $1,000, got the car fixed. Now she can make her appointments. Well, all of that is now gone. And some plans are holding on to that because it's their money. They can choose to buck the system and say, well, we're still going to offer that. But Medicare-wide, they said, okay, no more value-based healthcare. Now we're going to go with what's known as SSBCI benefits, which stand for Senior Supplemental Benefits for the Chronically Ill. So, in a nutshell, in the past, and still in 2025, if you qualified for Medicaid, you automatically got a food card that could also be used for utilities. But that is no longer the case. They're saying, hey, value-based is out. If there is a need, then you qualify. What's the need? The need is that you have to have a chronic condition that's on a list. So, example, if you're diabetic or pre-diabetic and being treated by either metformin or by diet, that counts, because your doctor would just have to fill out a form that says, yes, they're diabetic. If you had any cardiovascular issues, if you had any heart issues, if you had any lung issues, all of these qualified for chronic special needs plans. But what they did was now they added a much larger list. And they're saying if you have Medicaid, or even if you don't, and when you fill out that health risk assessment, or if you've been a client in the past, they're going to look at what they've been paying for and assess, do you meet the criteria? And they added things as simple as high cholesterol, high blood pressure, and then they added some of the big boys like Parkinson's, for example, is now on the list. So they see that they've been paying for, name your statin du jour. That means you got cholesterol issues, or your blood pressure med, metoprolol, amlodipine, losartan, lisinopril, whatever the case may be. They're going to say, okay, this person has high blood pressure, hence he or she qualifies for the SSBCI money. Okay. And then depending on whether you have Medicaid or not determines how much you're going to get. So that's a huge, huge change, because there are some people that are on Medicaid, but they're relatively healthy. Okay. Unfortunately, the majority are not, because the lack of money usually affected the lifestyle and the diet, which caused all these issues. But there's going to be a percentage there. They are going to be in culture shock because they were depending on that money to help them with rent or electricity, cable, or their water bill, because you didn't have to use it for food. Okay. Yeah. And all of a sudden that money is gone. But another change that's very important is if you fall within that, that demographic, you're on Medicaid and you do have a condition and you qualify. In the past, this was not seen as income, because if it was seen as income, if you're getting an extra $2, $3, $4,000 a year in income, it could now disqualify you for Medicaid. Well, in 2026, if you use that money for food or any of your utilities, and you live in Section 8 housing, in other words, you're getting assistance with housing, now you must report it as income, and it can now cause you to lose your Medicaid. So I tell all my clients who fall into that criteria, use your food money, rather, use your own food money, your own personal money, okay, to buy food, or rather pay your bills and utilities and everything, and then just use this money for food. Do not pay your utilities because you only have to report it if you use it for utilities.
Okay.
Now, because of the fact that it also covers healthy foods, it may limit what you can buy. In other words, you're not buying Coca-Cola, you're not buying ice cream, but you don't want to lose your Medicaid because now you got to report it as income.
Okay.
Big chunk of change, I know.
Sure.
I came out swinging.
Yeah. Okay. Gotcha. All right. What else?
Well, I mean, we got, of course, Social Security, the 2.8% increase. That's great. As far as the rest, it's pretty much now the same as usual. Those are the major changes for the next year. There's nothing else right now. Well, let me say this. PPOs are sort of being reined in, and that's because they cost more money. So we're seeing a lot of what we call, not suspension, but where they're trying to no longer sign people up on a certain plan. So they'll make it non-commissionable and remove it from the portfolio that an agent can use. So, for example, there is a PPO that's called a full access PPO. It's a Humana plan. And I quote Humana a lot because Humana is king in my part of the world, but I'm contracted with 10 different carriers. And this was designed for people who like a Medicare supplement, but don't want to have to pay the Medicare supplement price. Because what people love about a Medicare supplement is they can go see any doctor that accepts Medicare anywhere Medicare is accepted. Well, when you have a PPO, which allows you to do that, typically it's a lower cost in network and a higher cost out of network because they're trying to dissuade you from stepping out of the network. Because when you do, they have no idea how you're going to use it, hence, and they got to pay more money, hence they can't really budget it well. But when you're in network, because it's a contracted rate, they know exactly how much they're going to spend. So they're saying, let's persuade them not to go out of network. Well, Humana, what they did was they created a plan where in network and out of network is identical. Nothing changes. And so now it didn't matter who you chose. You didn't have to do so based on money. You did it based on need. And it became quickly the number one selling plan over the number one selling HMO, which was the previous several years. It was the big runner, the give back. And they even give you back money for your Part B on this plan, which I tell people, there's your copay money. Whatever you don't use, you keep. So it's a huge, huge plan. But what we're seeing now, like in my area, WellCare, Devoted, Cigna, which is now called HealthSpring, they went back to that name because they were sold again. They all got rid of their PPOs. They're strictly HMOs. And then we're seeing United Healthcare, Aetna, Humana, the big three, and they are United Healthcare number one, Humana number two, Aetna number three in that order. And they're reining in those PPOs, and they're freezing others that if you're on it, you're grandfathered, but if you change it, you can't get it back. Okay. So I'm telling everybody, do not lose that plan unless it is a financial situation where you can't afford those co-pays anymore. So that's the importance of the PPO. And they're trying to rein those in because they're trying to manage cost.
Okay. Eddie, I've got another reason why I had invited you on. I've got a little bit of a selfish reason. My girlfriend's father is turning 65 later this month, and he and I were talking about, Medicare options, and I had to admit to him, I'm not an expert on Medicare programs. Okay, my age group is not yet to that point where we're thinking seriously about getting on Medicare. Uh, I haven't paid a lot of attention to it, but I do recognize that I'm not an expert, and he needs an expert. Um, Somebody like yourself that knows this in and out, is living, uh, eating, drinking, breathing this stuff every single day. And so I just wonder, for a guy that's about to turn 65, what advice would you have for him? Because he's going to listen to this podcast episode after we're done.
Well, first of all, I tell everybody, do not make any decisions on a healthcare plan based on what you think might happen in the future. Look at your health right now. Why? Because these are 1-year contracts regardless. And there are two types of agents: captured agents that work for the insurance companies and fiduciary brokers that work for you. If you have a fiduciary broker like me, I tell all my clients, if life happens throughout the year, I'm going to change your plan, because contrary to popular belief, I could change your plan at any point throughout the year if I have a legitimate reason to do so. I can't just do it, because I have an itch. You got cancer, I can do it. You got a financial devastation, I can do it. You have a need for certain medications and it's not being covered. There are ways that we can find codes that will allow us to make those changes. So you have a hurricane or an earthquake, some kind of a natural disaster, and you missed the opportunity to make that election, we can still change it. So that's the first thing. The second thing is when you're looking for a plan, like I mentioned before, HMO, PPO, a lot of people, they just want to, go to that PPO strictly because they don't like being told what to do. Okay? The math never lies. Do the math. And what do I mean by that? Well, I get a lot of people to come to me and they say, I'm turning 65, but I'm still working. I intend to continue to work, and I have the option to keep that plan or take my Medicare. What should I do? Okay? So my first thing is, I said, do the math. Because see, you can keep that plan and take your Medicare, and it's not going to affect you. You can have both. The problem is you're paying for both. So, who wants the added cost? So typically most people are going to take Part A because it costs them nothing if they've already met their 40 quarters, leave Part B on the table, and they use this plan at work. But I say, take a look at what are you paying on a monthly basis for your plan. That's the first thing. Second, is there a deductible that must be met before they pay anything? Because unlike traditional health insurance, Medicare is a day one, $1 coverage with no pre-existing condition exclusions. So the minute you get it, it starts paying. Third, see how many specialists do I see a year? And then let's say there's 4 of them. How often do I see those specialists? Let's say for easy math, it's once a quarter. So you got 16 specialist visits. Well, take a look at what are you paying per specialist visit on that plan, add it all up. Okay, and then take a look at what would you be paying on a Medicare Advantage plan and add it all up. Okay, and then look at these things as well, like the Part B give back. I tell people, if you might be paying $1,000 a year, argument's sake for easy math, if you stayed on the plan for those specialist visits, and you might be spending $1,200 over here, but they're giving you back $170 a month. So you're getting $2,040 for the year. So when you subtract that, okay, you're really not paying anything and you're keeping $800. Okay, because it's not what you get, is what you keep. So, you also want to take a look at what does hospitalization cost? What will my medications cost? Am I paying a copay now? Am I paying nothing? Because with most Medicare Advantage plans, people live in tiers 1 and 2, the generic tiers. And typically the generic tiers are zero copay. And then you start getting into the lower tiers, it gets expensive. But with other traditional health plans, that's not the case. It might be a low copay. It might be $10 a month, whatever the case may be. But if you're taking 4 or 5 meds, all of a sudden you're spending $40, $50 a month. That's $600 a year. And if you went to a Medicare Advantage plan, you're spending nothing. Again, the math never lies. So do the math. Now, another thing you want to consider is Social Security. You know, a lot of people don't realize that the reason you have Medicare is because that's the 4th policy that you get with Social Security. You have 4 policies with your Social Security account. You have an annuity, life insurance, disability, and health care. So, you know, taking a look at also, you know, when am I going to take Social Security if I'm not already taking it, you know, is going to be a key factor. And then if you are not taking Social Security, you want to tell everybody, go online, Google Easy Pay. And this way, you fill out that form and you pay on a month-to-month basis for your Part B versus being billed quarterly. Now, why would that matter? Because if you're going to get a Part B give back, it could take 3 to 4 months sometimes for that to be put in place. And all of a sudden, they'll give you all the money back, you know, backdated to when you started. But you're going to get a bill from Social Security for a quarter, you know, at a pop. So when you take 206.50 next year, you multiply that by 3. Okay, we're looking at 618, 1950. And once you pay that bill, if you're not on Social Security and everything goes into place, they're not giving you that money back. What they're going to do is say, oh, we're going to keep that in your account and we'll bleed from it until such a time that it's all used up. And then at that point, we'll start taking that money out. Well, a lot of people don't like the idea of having to fork over $600 when all they had to pay was $21.50. Okay. But if you submit that Easy Pay application, then you're only billed 1 month at a time, in which case they would pay that $206.50. And then, you know, Shazam, everything caught up. Now you're only being billed, you know, $21.50 if you're getting $185 a month, you know, $41.50 if you're getting $170 or $46.50, whatever it is. My math is not great in my head here, and which is a lot more palatable, you know, on somebody's Social Security, for example, or their retirement savings.
Okay. So, Eddie, I'm sorry to say, but we are out of time. I really appreciate you coming on the podcast and sharing your wisdom here. I think that it's gonna help our listeners. It's also gonna help my girlfriend's dad. I really appreciate it, and I'm also, you know, I'm gonna put him in touch with you or one of your associates to get some help, you know, one-on-one. We will put your contact information in the show notes. So if anybody else that's listening wants to get in touch with you, they can. All right. Until next time, everybody, if you can leave us a review, that is very, very helpful. Leave us a rating. If you like the episode, maybe forward this episode to somebody you think could really benefit from hearing the information. I love that. It helps other people discover the podcast too. And if you happen to be a licensed agent or adjuster and you need insurance continuing education, check out our live webinars at BMFCE.com. We'll be back with another episode in just a couple weeks. Thanks.